Good afternoon, everybody. It is Tuesday, the 12th of January, 2010. This is Brian Shannon speaking. We had the market sell off here a little bit today. The S&P 500 initially gapped lower and below yesterday's support that had been prior resistance from Thursday and Friday of last week. And then we did kind of stabilize above that 5-day moving average and also the trend line that we had noted earlier in the morning at 113.75. But midday we saw a continuation of that downward movement, and now the market is just above the prior level where the larger breakout came from, which was that 112.80 to 113 level that was plaguing us for the for basically the last 2 months of 2009. So let's take a look at a 90-minute time frame. We can see here on these 90-minute candles where that 112.80 to 112.13 level had been. We, of course, on December 31st made a brief dip below that level and down to the 20-day moving average before recovering. So the uptrend is really still intact if you look at the daily time frame. I mean, we're still holding a 10-day moving average on a closing basis, and that 10-day moving average is above the 20 and the 20 is above the 50. The last week we were noting that it was getting kind of easy to make money on a lot of these names where arguably they were a little bit more speculative, and at the same time we had started to see stocks like Apple and Google, Google, and Baidu starting to decline. So we had seen some weakness in some of these larger cap stocks. Well, it was the little garbage that was coming up, and we were using that as a reason to be cautious, but still optimistic because the trend obviously remains higher. So the S&P 500, I still think we need to maintain above 112.80 to 113. If you look at the year-to-date numbers, it's not all a great picture here. The Nasdaq barely positive for the year, just a couple pennies higher basically is what that amounts to. And the semiconductors are down 1.8% today for the year after being hit by 3.5%. So we'll take a look at those in just a moment. But the Nasdaq for the S&P 500 right now, we're going to view 114 as a potential level of resistance for tomorrow. In the after hours right now, we're seeing a little bit of a bounce here, trading at 113.80 basically. I don't know if there was further news right now because it's just 5 minutes after the market close. But today's weakness was really brought out about the catalyst. I think the biggest catalyst was this Alcoa reporting earnings, gapped lower and stayed weak all day long. So the message here is that the market has taken on a lot of risk, and people have been a little bit confident looking at this easy money the market has been providing us for the last couple weeks. And now that we have a catalyst here, that with the beginning of earnings season, and today obviously the earnings were viewed negatively from Alcoa. You can look at it and say earnings were this or the revenues were whatever, but the fact is the way the market responded is the only thing that matters here, and it sold off and continued to sell off throughout the day, remaining below that daily VWAP for all but about 20 minutes of the day or so. So we've got, I think, a reassessment of people reassessing the risky positions they're in, and that may lead to a couple more days of weakness. So it's time to kind of throttle back on the risk, and that's something we've been talking about. Let's see how the market responds, if it can hold up, they were at 112.80 level or so. But some of the other areas of the market make me think that maybe we're not going to hold, and that would be, first off, the Nasdaq. If you take a look at the daily chart of the Qs, we had gotten below the low that for the December 31st low, came down to the 20-day moving average. So officially, I mean, we're still in an uptrend. You can take a look at a trend line that looks like this as well, and figure maybe that will hold. And the bigger level of expected support on continued weakness is this 44.80 level, but the uptrend remains intact on the daily time frame. It's when you look at the shorter term time frames where we begin to see the weakness. So here on a 30-minute time frame, we can see that we closed below that $46 level. level. And this is what I'd spoken about yesterday in this morning in the midday video, that we didn't want it to close below that level. Now we will be viewing this 46 level as resistance tomorrow. And basically, as long as the market stays below that $46 level, any long side trade should be considered short-term trade opportunities, just as below 114 on the SPY should be considered pretty much short-term trades. So back to the NASDAQ 100. When we take a look at this, we are below the declining 5-day moving average as well. Last time we were below it, we covered quickly, and we were looking at this as the key level. So now the 46 is the key level for the market to get back above. But if we run up to 46 and then make lower lows, it's possible that that is, if we run up towards 46 and then break down through this afternoon's low, this near 45.50, then we could be headed for a test of the next bigger level, which is 44.50, which again here on the daily time frame is the basis of the breakout from this ascending triangle we had observed late last year. The Russell 2000 was down 70 cents. 1.09%, still above the bigger breakout level, obviously at 62.5, that will take on more significance, as that's where we also have that rising 20-day moving average. Taking a look at a 30-minute time frame here, you can see we've broken some support that was this prior resistance late last year as well, near 64 bucks a share. So now 64 is kind of the line in the sand that the buyers are going to have to get this market back above in order to hold. We do have options expiration on Friday, and that could mean that maybe we're just kind of going to drift into that. But if we break a low below the December 31st low, 30th I guess rather, that level right here at 63.20ish also takes on significance, as it is the location of this most recent, most valid trend line that takes us from basically early December. So if we take a look, and we can actually extend that back a little bit further and see that this trend line was actually broken. So I was looking right there at this level here. So sometimes it's better to back it up and take a look at the bigger picture. So a trend line break doesn't mean that a reversal is at hand, but certainly the rate of ascent has slowed enough so that the pattern of higher highs and higher lows no longer exists, and we may need to correct more through time. So we'll need to get back above 64 before we can really get more aggressive on the long side. And it's time to step back, I think, from some of these smaller stocks that have really been running strong lately. Today, intraday, I had mentioned a trade in Seed and SEED, as it had broken above $14 a share. My stop was below there. I'd mentioned getting out in pieces and never got back involved in the stock. And you see, if you held the stock, you would have actually been down. It was, the stock finished lower on the day today. So you got to be quick in this environment. I mean, there's some great moves occurring, obviously, and if you're patient enough to wait for the right setup and then disciplined enough to take them and recognize some profits, then it's still a fertile environment. The semiconductors unfortunately did break below that 2750 level. That's the level we've been viewing as the more important support for this market as well. Right now, the market got sold off pretty hard. I think that I'm not really expecting 2750 to offer much resistance if we start to get a snapback bounce. I would look more for this 2780 area for it to occur, and then maybe if further decline from there. We do have a declining 5-day moving average that says be careful in the intermediate term. The financials were down 22 cents, so they did break below the 1510 level, and they are below that 5-day moving average as well, the orange line. So we're going to be looking at 1510 as potential resistance now. If it can get back above there, then maybe we'll see a little bit further strength in the financials. But if the last couple days I've been saying that I've been expecting this market to pull back, maybe down towards 1480 or so. And if we take a look at Fibonacci, let's just draw some quick fib lines off these lows. That is the mid-December lows from 14 bucks a share to that 1540. A 50% retracement will get us down to this 1470 level. That's a possible area where we may encounter some support. We don't want to buy there, but we want to look for evidence that the buyers are taking back control. These Fibonacci levels are not magic levels. They're just levels that we want to look and see if the buyers do in fact show up there, then the market begins to stabilize, and if so, then we want to buy subsequent strength. But the financials. So here's this. We could take a look. A pullback even down towards this prior resistance near 1460 to 1470 would still be okay, and I think set these up. I mean, they found resistance right where they were supposed to at these prior highs and the level where this island reversal occurred back in October. So now if we see, the one troubling thing I suppose is the heavier volume that we had seen on the sell-off. Ideally, we would have liked to have seen, lighter volume than yesterday, and then followed by another light volume move, and then a push higher. It's not a buy, but it's a buy, something that we want to stock as a potential buy. Otherwise, it may fail, and obviously you don't want to buy weakness. You want to wait for the buyers to emerge, the stock to stabilize a little bit, and then buy on strength. Let's take a look finally at the IYR. The second shoe beginning out this year, on a down note. It is down for the year, and it tried to recover here over the last week and a half. We've been talking about that, about maybe if it was able to get back above that 5-day moving average and the 5-day moving average flatten out, and then take out this 4650 level, that it would be more bullish for the commercial real estate. But it gapped lower this morning and continued lower, so I would say treat this group very cautiously. Could be headed for a test of the 50-day moving average near 44.30. And lastly, I just want to take a real quick look at gold. Gold has been recovering nicely. I was saying yesterday that the problem with gold is that it gaps, and you have to be willing to tolerate these gaps. The thing about gold is if you want to buy it, it's probably a good buy in this area, but I just don't like buying the weakness like this. So as I always say, if you're interested in gold, I'm not the best gold trader. I don't like the way it trades with all the gaps. Subscribers, I'll have that second video up with the stocks to take a look at and a review of today's stocks up in a couple hours.